Let's take a look at this second one. What we have here is a prepayment for rent, and I'm going to prepay a 4-year lease in advance. The advance was $16 million, and for taxes I'm going to take it in the year that I paid it, which was 12/26 year 1, and that's going to be right here, and it's going to be 16 million, and I'm going to take nothing there. So the temporary difference in year 1 is 16 million. And then what's going to happen in year 2 through 5 is going to be, I'm going to take 4 million here, 4 million here, 4 million here, and 4 million here. And each time I'm going to be updating that balance to reflect the fact that now the tax difference is not 16 million, it's 12 million. It's not 12 million, it's 8. And then it goes down to 4 and 0. If you think about depreciation and how depreciation ends up expensing the entire asset, that's kind of the same pattern as this, is that you are reducing it over its life, basically. And now what we're going to do is let's do year 1 income taxes and a journal entry for year 1. All right, so year 1. What we're going to do is we're going to solve for a couple of things. We can solve for the deferred tax liability, or we can solve for taxes payable. I like to do the liability first, and let me go ahead and do that. This is my DTL. The difference is 16 million times the tax rate. In this problem, the tax rate was 25%, and that gave us 4. This started out at 0, and that's my adjustment. And so it's 4. Tax expense, deferred tax liability is for 4, and then taxes payable we have to figure out. What it tells me is that pre-tax income is 46. All right, and what I need to do is figure out what that's going to be after I take this deduction. 46 million was my starting point. However, I took this 16 deduction, and so that gave me taxable income of 30 million. And that's what I'm going to do this taxes payable based on. So 30 million times 0.25 gives me 7.5 million. And that then gives me tax expense at 11.5. Right? That's pretty straightforward, I hope. Let's go ahead and do year 2. Same process. I'm going to go and do this deferred tax liability. It ended with a balance of 4 in last year, so it begins with 4. Then I need to figure that out. And if I look over there, we know the book to tax difference in year 2 is going to be 12 million. And multiply that by 0.25. Good, 3. All right. And this is my adjustment for 1. And now I can write this journal entry, tax expense, and I don't know that yet. Deferred tax liability is going to be debit side for 1. And then my taxes payable. For 60 million was the pre-tax income, but I have to remember now that that the difference between book and tax now is that under book I'm taking a 4 deduction, under taxes I'm not. And so what I need to do is I need to add that 4 that I amortized down there. I need to add that to give me taxable income. And so taxable income is going to be 64. and times 0.25 gives me taxes payable, and the rest is kind of going to be easy, which is 16. So this is 16, which then makes tax expense 15 in year 2. We're going to add this condition now, which is that the tax rate changes from 25% to 15%. And how's this going to affect things? Well, deferred tax liability. So let's go ahead and do that. So this DTL, it starts out at, if you recall, it started out at 4. Because at the end of year 1, I adjusted by 4, which was the 16 million difference times 0.25, which was the tax rate at that time. And then I'm going to come down here and determine what it needs to be, and it needs to be 12, because that's the existing book to tax difference at the end of year 2. 12 million times 0.15. And that's going to give us 1.8. And that's where it needs to be. The adjustment is right there. Okay, let's go ahead and adjust this journal entry for our new information. They said that the new rate is going to apply for years starting in year 3, which means that it's not going to affect my income taxes payable, because in the current year the tax rate is 25%, and that's going to remain to be 16. Deferred tax liability is 2.2, like what we saw down here, and then tax expense is just going to be what it gets me there. So this is 13.8. What are the takeaways from this question? Well, to learn kind of the pattern for book to tax differences and be able to adjust the deferred tax liability, to recognize the fact that accounting income continues to take that deduction and reducing that temporary difference. That's the first thing. Second thing is that when there's a tax rate change, I'm going to change my computation for the ending balance in my deferred tax liability account. If it's in the current year, I'm going to adjust that taxes payable for that. However, if it's for the following year, I leave that rate at the current rate. Those are the takeaways. So there you go.